You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. And before we dive into the show proper, let me just remind you, if you haven't had a chance to check it out, run, don't walk, run over to your favorite app store, the Google Play App Store, the iTunes App Store, even for you Amazon lovers, the Amazon Kindle Fire app stores, and download our new Options Insider Radio Network mobile app. It'll allow you to download all of your favorite episodes of the show. You can stream them from pretty much everywhere. You could download them, like I said, and store them for offline listening on the subway, on the plane, wherever you like to listen to your favorite Options Insider Radio Network programs. You can get them all right there in one easy place. I know that's particularly interesting for a lot of you Android folks who have all kinds of different handsets, and there's all kinds of different pod-catching programs over there, and it's really kind of a pain to get the content on the Android side. Now you have one-stop shop to get all of your favorite Options Insider Radio Network programs. That's, again, the Google Play App Store, the iTunes App Store, the Amazon Kindle Fire App Store. Search for the Options Insider Radio Network mobile app. I think you're going to like it. And, of course, joining me on the old Volatility Views panel, as always, my co-host, my partner in crime. I think this week he'll be the light side to my dark side, none other than Mr. Mark Sebastian from Swan Wealth Advisors and OptionPit.com. Mark, welcome back to the show, sir.
Hey, well, thanks for having me. I actually just got back from Durango. Spent 4 days there with the team.
Scenic, lovely Durango. Doing some skiing?
I'll tell you, you know what? I left Chicago. It was 10 degrees. I got to Durango. It was 60. At 7,000 feet of elevation. It was 60 degrees. I was like, this is awesome. And of course, I left just in time. They're going to get like 3 feet of snow over the weekend. But, it was a lot of fun. We got a lot of work done, met with some really cool people, and just business. Of course, we're knees deep into reinsurance right now. So that's the subject du jour at Swan over there as well.
And, of course, this is usually the part of the show where we dive into our volatility review, but we're going to switch it up a little bit and instead start off with our volatility viewpoint because we have such a great guest waiting in the wings. So without further ado, let's dive right on into our volatility viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right. I hate that drop because it always makes me hum in my head, money for nothing, for the rest of the episode.
Money for nothing.
I curse the people who put that into our drop.
I am the Sting to your Dire Straits.
Yes, you do add that little bit of falsetto to the show that we need. All right, before we get too far down the 80s nonsense music rabbit hole, allow me to welcome on our guest. You may remember him from his previous appearances on the program, but it has been a while. He is Jared Woodard, the founder of Clinamen Financial Group, as well as the founder of Condor Options. Jared, welcome back to the program.
Thanks a lot. I'm really happy to be back.
Now, it's been a while, like I said, since your last appearance. In fact, I looked it up before you came on, and it was all the way back in December, early December, actually, of 2012. So it's been well over a year since your last appearance on the program. Seems hard to believe. In fact, on your last appearance, I remember it well, we had a great, very excited discussion about Black Swan and Mr. Talib and all that fun stuff. That was a good one.
That's right.
That was a good one.
Right.
So we may have to go into those waters again towards the end here today. But Jared, it has been a while since you've been on the show, and indeed your business card has changed a little bit since the last time you were on. You are not just the major domo over there at Condor Options, but you've added a whole new line to the resume. So why don't you go ahead and tell our listeners what you've been up to since the last time you were here on the program?
Yeah, I guess over the last year, two big things that have changed for me were getting a little bit more into the money management area. So I manage accounts as a commodity trading advisor. My firm's called Clinamen Financial Group, and it's a pretty small sort of startup type outfit, if you will. But we trade volatility arbitrage and big products and anything with a pulse to it in terms of futures options. And then the other big effort is a big research product that I've been working on that I launched late last year. That's designed to kind of provide resources that are on par with, or maybe hopefully better than, in some cases, the sort of derivatives research that you might see from a typical sell-side research department. That product's called Volatility Tracker, and it looks at implied vol, term structure, options opportunities that come up in the market, and giving both analysis and trade ideas based around that data.
Let's start there because that is a pretty cool tool and a pretty cool effort in general. I was playing around with it before the show started, and I have to say I was immediately drawn to the very cool global map of implied volatility premium, I guess you can call it. That was pretty cool. So let's start there then. Let's give us an overview of the vol tracker and indeed that cool visual cue there of the global risk premium.
Sure. Well, so that map that you're talking about has a purpose of trying to give you a snapshot of where options are trading relatively expensively or relatively cheaply around the world, and it tracks the ratios of implied versus recent realized volatility in different countries. Any country that has really active listed equity index options, lots of countries have VIX style indexes for them now, and so we aggregate all that data, kind of smooth it and rank it a little bit so that it's easy to compare apples to apples. And that map just shows you 2-year sort of percentile ranks of where the volatility risk premium is high and low. And so we always track that in each issue and discuss, what's happening there. And that's the feature that people seem to really like a lot, just as a way to get a quick look at where options are really moving and where they aren't. And I guess there's a lot of different features in the product. It's usually about 14 or 15 pages long, but I could mention just a couple that I think are pretty interesting. One of my favorites is just a pair of tables and some associated charts where we track where the term structure of implied volatility is especially steep or flat, as the case may be, in different assets. As a way of looking at, a lot of us are pretty familiar with looking at contango or backwardation in futures markets or in VIX products. Certainly has become a hot theme in the last year or two. But of course, you can look at changes in implied vol term structure in really any asset that has active options. And so that's something that we do for whether it's stocks, equity sectors, some commodities, currencies as well are in there. And I think that's a really helpful way to key into where markets are sort of changing, where the sentiment is really changing. And it's a great way to look at different time spreads, a great source of ideas for time spreads like double diagonals or calendars or what have you. One other feature I'll mention too is that I especially like is some of the correlation work that we do. So looking at, even if you don't trade options, volatility and correlation are really important, even if you're just trading, stocks up and down. And so we look at realized correlation as well as implied correlation at the index level, and then also at the level of equity sectors. So one thing that I added just recently that I quite like is the CBOE publishes some implied correlation indexes that track, I think it's the top 50 stocks in the S&P, and so they give you a sense of where implied correlation is moving at generally a kind of a 1-year horizon, or at least each index expires every year. I kind of smoothed this out to create a constant maturity index at a 1-year horizon to give it a much more sort of consistent look. And so that's the kind of, and that kind of has some value to it as a market indicator. It also tells you what traders are thinking about in terms of the stocks they're trading versus index options. But the main point is that there's a lot of tools, a lot of different features that I think are really, really valuable for developing trading strategies and trade ideas. And my overarching purpose has been to only include things that I can't get elsewhere, that you don't really sort of already see in every other, on TV or in every other kind of article around the world. So my goal has been just to provide indicators and tools that are in some way novel or really helpful in a special way.
Yeah, you've put together a lot of interesting different research reports and tools over there. I've kind of been sorting through them as the show was approaching here over the past week, and it's quite a bit to get through. It's quite amount of content you put out over there. I was really interested as well in some of the recent stuff you put out. In fact, I think it was early February, you put out a piece called Buying Volatility at Any Price. Like the title, we talk about that a lot here on the show. People tend to want to dive into these products regardless of vol level, regardless of kind of anything else that's going on in the broad market. But you really broke it down in some interesting ways. You broke down, of course, like I said, the correlation that's going on out there, as well as what the market is doing, even in some of these, I guess abnormal is probably the best way to call them. These abnormal days like we saw a few weeks ago where the market was selling off aggressively, 1%, 1%, people still coming in. And even on days when there's up moves, dramatic up moves in the market, people still willing to come in and pay what is comparatively inflated levels for volatility. So why don't you walk us through some of the interesting findings you pulled out of that piece recently?
So the buying volatility price, sent that out to volatility tracker clients because it was kind of a time-sensitive thing that we noticed, which was that the market was rising on a lot of different on a lot of these days in February, and instead of seeing the typical action in options markets that we would expect, namely VIX futures declining, implied vols and SPX going down, we were seeing implied vols stay flat or even increase in some of these days. I ran a little bit of a little historical regression looking for similar instances, and these days, this pair of about a week in early February was pretty unusual historically for seeing these kind of occurrences, especially the level of change in implied vol and equity price kind of moving in the same direction. And so to follow on from that, not just to note that it's unusual, but to see what has happened historically on similar occasions, I looked for cases with similar behavior and looked at equity forward returns at a 1 day, 1 week, and 1 month horizon. And what's interesting, I thought this was pretty counterintuitive, actually, these results. Instead of that bid and volatility being a kind of a warning sign that, hey, traders know something's up, they're suspicious, they're bearish, they're bidding up vol because something bad's going to happen, which was my intuition. In fact, what the return showed was that these instances were actually very bullish for stocks, at least it had been historically, that at every horizon, 1 day, 1 week, 1 month, you had better than average, significantly better than average forward returns if you were to just buy the S&P on those occasions.
That is very surprising because you're right. The immediate conclusion most people I think would leap to is, the fear is percolating up. People are picking up some S&P protection against their portfolio. That's kind of the immediate conclusion to that. And then, of course, we're bracing for a near-term or maybe longer-term historical type correction in that environment. But you're saying it's actually the opposite, that they're chasing vol premium and yet the market is still rallying regardless.
Exactly. And it was surprising. I didn't expect that. I was ready to close out some positions, some short vol stuff and start to hunker down a little bit myself. But on the back of that research, it kept us kind of in positions and it kept us long the market, especially long some deltas that turned out pretty well. I can mention too, as we're looking at the markets right now, towards the end of February, there's been some similar cases this week, similar instances, not to the same degree, I don't think, but that same feeling of vol being bid up certainly not selling off even as the market churns higher. And it'll be interesting to see over the next week or two whether we get a repeat of that same phenomenon.
Yeah, I mean, I was going to say we're kind of seeing that right now. As we rally, nobody is selling calls, and the skew is remaining. It's interesting that puts are remained relatively robustly priced. Just kind of the normal vol, but it's really where I've seen a lot of the bid has been on the call side of the curve. I know you track a lot of skew. Maybe you want to. Would you like to speak to that?
That's an interesting point. I noticed that skew index that comes out has been high, and it's for me it's always so tricky to try to interpret that in any intuitive narrative kind of way. But
right.
But you're absolutely right. I mean that seems like some of the big orders. That seems like what's happening in the data, and I wonder whether it's not just a lot of traders who have seen weaker economic data so far this year and are wondering whether maybe in the next earnings cycle there's going to be some bad news or something like that. But I think you're right that it's not so much massive put buyers coming in as it is people who are neutral and don't want to really commit in terms of selling their upside. I don't know.
Well, and I think the skew index is not what you and I think of as skew, right? It's almost more, and here's where we get into Taleb. It's almost more a measure of how much it costs to do the Taleb trade all the time, not how much it costs to do the traditional collar. And I think that's actually a big thing. A lot of people misinterpret the skew index to think that it's means that the normal put people use to hedge is bid. I think it's all based on those tiny little dollar cheap options, isn't it?
Yeah, you're absolutely right. That's a really good point. I'd like to see, someday I'd like to either see or publish, here's a 25 delta linked index, here's a 10 delta linked index, to get a sense of what's happening at different points along the curve, in a more straightforward way.
A lot of people got excited about that skew index when it was first announced. It seems to kind of have fallen off a lot of people's radar for, I think, some of the reasons Mark just outlined, and also the fact that it is kind of quoted in this oddly obtuse fashion, which isn't really intuitive for a lot of people. And also, you're right, it isn't what people want. They want that kind of 25 delta call and put kind of more risk reversal type indicator than this kind of extreme black swan type indicator that it seems to actually be. Do you use the skew index that much, Jared? Is it really kind of just something you pay tangential attention to?
Yeah, to be honest, I monitor it. I actually publish what the sort of quantile ranks are in the research report, and that's mostly because of client requests to do that. But yeah, I mean, I think I'm share the same concerns that we just reviewed. It's not something that's really intuitively useful to a lot of traders. And if I'm really curious about what's happening in the curve, I usually just go and look at the option data itself rather than that index number.
Yeah, that's true. If you're familiar with the options, you can go pull that data yourself quite easily. You don't need to wait for the dissemination from the SIBO for the skew index. But, before we move on, I'm still trying to wrap my head around what we were just talking about earlier about the people chasing vol, getting into vol, even on rising index levels, and yet the market has fantastic forward returns. I'm just trying to see what scenario really fits that. I suppose people are scrambling to hedge, but then once they hedge, they're essentially content, and so they can let it ride a little bit more. I'm trying to think of what other scenario would fit that, where people are chasing volatility, bidding it up, even on an up move in the market, and yet the market then continues to rally aggressively in the next coming sessions.
That's totally plausible to me. One thing I've also noticed, or a kind of a scenario I've tried to come up with is one where whether there's some specific risk scenario on people's minds or not, if they're think the market's maybe going to roll over because it's been trading flat for a little while, maybe that's a good, you go out and you buy some vol, and if the market starts to rally a bit, maybe you buy a little more if you really have a bearish look, and then eventually you kind of capitulate, sell out of those puts or whatever. I could see that happening in a situation like we have now, where implied vol is at at nominally low levels, VIX in the low teens and so on. And that kind of story would be more of just like, it's kind of the same ultimate trading action. It's just that the change in vol and change in equity price would be asynchronous, whereas normally they'd be kind of more synchronized together on a day-to-day basis. You hear anecdotal reports of traders kind of putting on big bids for some vol and then getting out of it a little bit later. And it might just be that you have that kind of mismatch happening on a day-to-day time frame.
I don't want to flip the script too much, but you're coming on at an interesting time, Jared, so I want to make sure we have some time to talk about what is probably the biggest development in the vol world, at least over the past few weeks, is not anything to do with VIX and the usual suspects. It's actually out in the commodity realm, in the nat gas realm, where it's just been a volatility explosion. It's been a volatility free-for-all out there. In fact, we work with a lot of different retail brokerage partners over here. A lot of them have some small or mid-sized futures operations as well. And every time I talk to those guys recently, all the risk guys can do is just focus on nat gas, because it seems like the trade in nat gas for the better part of the last year has been to write that 3.5-4 strangle or something along those lines. And premium writing has been the trade du jour because it worked quite well until the past few months, when all of a sudden nat gas is just on a tear, and the volatility out there, not just close to close, but even intraday, is just swinging wildly. You can put on things at levels in the morning that you could take off for orders of magnitude higher in the afternoon with not much change in the underlying, and vice versa. So I know you've been paying a lot of attention to the nat gas vol as well. What's your take on what we've been seeing out there in recent sessions from a nat gas volatility perspective?
Yeah, you're right. It has been really incredible to watch and trade too. So I'm not the most intraday of traders typically, but we've done some pretty good, multi-day, multi-week positions that worked out well after the big explosion. Fortunately, I just happened to not have anything really on when things started moving. But I know, as you mentioned, there was kind of a lot of strikes on the upside that got hit when the futures sort of backwardated sharply, and you had the weather kind of driving that move higher. I think that it feels like the move is kind of over now, just with the, sort of turn in the weather. But one thing I noticed, like the term structure of implied vol, even if you normalize it across different futures contracts, was hitting record levels. So it wasn't just the nominal, change in the option price, but the relationship between the short and long dated contracts got historically high as well, with the front months kind of just bid so high. It was interesting too when we got a spike in some colder weather came through more recently. You had a lot of that implied vol start to filter out into the into the April and May contracts, which hadn't been there before. And that's something that it's tricky to trade if you're used to just staying in this sort of land of ETFs. I think that it's probably been a really educational opportunity for a lot of traders who are newer to futures markets. But certainly paying attention to what contracts you're in and what the underlyings are has been crucial here, whether it's trying to trade the move directionally or in terms of spreads. And so now you have the prices have calmed down, implied volatility has calmed down, and now I think it's more of a just aftershock echoes type of a market in terms of trading new positions.
And you're right, it's a very painful, pricey education in the underlying, but c'est la vie, that's how it works sometimes. And you're right, that those kind of situations you just described where front months getting bid up, that usually offers a lot of great time spread opportunities where you can buy some of the farther off term structure, sell some of the near term. But you have to be pretty aggressive right now to want to be short any gamma, I think, in nat gas right now. So it's an attractive one, and yet also a terrifying prospect at the same time. Anything that gets you short anywhere in the near term of the curve there in nat gas could be quite dangerous. I was talking to someone just, I think yesterday actually, and they were relating some anecdotal story they had seen out there in nat gas, and it was getting towards expiration on a very near-term contract, and the underlying wasn't moving that much, and they were going to put it on in the morning for about $150 net cost of the contract, and they ended up not doing it, went off, did something else, came back towards the end of the session, and with the underlying not really having budged that much, that same contract was trading $1,500 at 10x. So
wow.
They're seeing and this was, I think, a relatively near out of the money call. The swings they're seeing out there intraday from a vol perspective has just been, that's where the trade has been over the past few weeks. So there you go, listeners, for all of you out there who are always writing in saying, talk more about commodity vol. There you go. We actually work some of it in here on the old vol review. I know you're covering a wide range of products out there, Jared, including, I know you've been looking a lot in some of the FX, the currency land, including the dollar Japan stuff. Again, people writing a lot, asking us about currency stuff too. We don't get into that much, so this is our opportunity here. Why don't you tell us what you've been seeing out there from the premium in like the U.S. dollar Japan options and how that's factoring into your research and your trading over there?
Yeah, we've kind of come full circle on the yen. I've been writing about and trading this since the story really got moving in, I guess it was late 2012. Abenomics got going and the currency started moving first, and then equities followed that pretty soon right away. We got a couple occasions in 2013 where yen implied vol just really exploded, and it's really calmed down quite a lot now to the point where dollar yen is pretty quiet, honestly. I mean, you're not seeing the same kind of momentum in the currency or in Japanese equities that we saw at different points in 2012 and 13. There's been a lot of flat trading, and I think that it's really just all driven by the underlying economics here, rather than by short-term momentum or trading or anything like that. I think that a lot of people have there's the three arrows of the policy, and the first two are kind of played out and done, and now it's time for some of these structural reforms to happen, and it's time for some more substantive evidence in the economy there. And while everyone kind of waits for that, the yen and also the equities there have gotten a lot quieter. And I think that the opportunity there is interesting because you've seen options get a lot cheaper. And so if you have a particular view about the success of the policy in either direction, this actually looks like a pretty decent time to maybe not trade in the short term, but if you want to start working on longer term positions or medium term positions, things are a lot cheaper than they've been for at least the last year or so, where the yen's concerned, and that's a kind of a new development, even if you look back 6 or 12 months.
And speaking of those other markets, you were kind of early on the emerging markets tip as well. Of course, everyone focused on Argentina and some other areas right now, but you actually got into it in late January with a research piece on emerging market confusion and saying that essentially options in some of these sectors were at the time priced near one-year lows when you compared them to SPY. I'd imagine that scenario has changed a little bit over the past month since you actually wrote this paper. But still, you were kind of early on in the emerging markets tip. Tell us kind of what you're watching out there now and how those premium levels in those different emerging markets have changed since you wrote that compared to what we're seeing out there in VIX and SPY land. Yeah,
I guess there's two interesting things that I've noticed looking at emerging markets recently. And the first is that a little bit of a mismatch between the economic prospects for some of these countries and the way that the options markets have reacted so far this year. I put up a chart showing the balance of payment status for some of these key emerging markets like Russia, China, India, and Mexico. Looking at just showing whether they had a current account surplus or deficit. Typically, those current account deficit countries have a bit harder time fostering economic growth and seeing better equity returns, at least when there's any kind of stress, like we've seen. And even though, so you can do a nice comparison of which countries have sort of what level of surplus or deficit. And you might expect that the option market response would be kind of in tandem, that traders would price those deficit countries as riskier during any kind of stress period, and then vice versa for surplus countries. In fact, that's not what we were seeing. The option market response, at least measured in terms of change so far this year compared to the standard deviation of changes over the past year, was really kind of all over the map. And what that suggested to me is that that at least for these shorter term, by which I mean month to month, quarter to quarter, rather than 6 or 12 months out, I think for the shorter term, traders are more focused on some of the idiosyncratic aspects at the country level rather than on global economic growth prospects for emerging markets in general, which is probably a good thing. And then that's kind of a natural segue actually to a second point that I've been reading about and writing a little bit about recently, which is the level of indebtedness in some of these countries. And this is actually pretty far afield from options, but just quickly, there's some research from economists at the IMF and also some guys writing for the Bank of International Settlements looking at how debt that we usually think about balance and payments in terms of the debt that countries issue, where it's ranked by or it's recorded on the basis of the residence of the debt issuance. What these papers were looking at is not just based on residence, but actually the nationality of the companies issuing debt. And so, for example, if you think about a company that's based in China, that has a foreign subsidiary in say London, and that foreign London subsidiary issues U.S. dollar denominated debt, well, that's ultimately the debt that a Chinese company is issuing. And if we record, and so these two papers just kind of aggregate all that data from all these foreign subsidiaries and record it, as if it were repatriated, as if it were, recorded for those home countries. And when you do that, the level of indebtedness for a lot of these emerging market countries is in some cases dramatically more, or even double what a typical balance of payments accounting would suggest. And look, I'm no like growth bear or bearish person in general at all, actually. But when you talk about growth prospects and you combine that with some of the hot money flows in and out of emerging markets that we've seen last year and this year, I think that it paints a little bit of a slightly gloomier picture for the upside for some of these countries over the medium term, when they just have that kind of overhang that they're going to have to work through, and also importantly, the kind of lack of flexibility that these countries are probably going to have when it comes to managing their currency, managing their interest rate policy, given the sensitivity that their own companies are going to have to all the foreign, especially dollar-denominated debt they've been issuing, when you combine that with the change in the interest rate cycle in the U.S. Altogether, putting that all together, for me, it makes me a little bit less sanguine about growth prospects in some of these markets. So if we do see rallies or rebounds, that might be something to sort of buy vol into from my point of view. And in the short term, of course, I'm happy to sell vol when it gets rich. But I think having a little bit longer term perspective on expectations for growth is really important.
Like I said, while you were talking, I'm just going through all the different offerings here on the different reports that you put out. There is a lot to go through, and more than we have time to really discuss here on the volatility viewpoint. But a couple other things I want to hit on really quickly. One of the interesting topics we've discussed many times on the show in the past, and you do a lot of research into as well, is the concept of just cross-asset volatility. For a long time there, we saw correlation and asset volatility across the board kind of moving in lockstep, where pretty much people were buying previous products that used to be a tool for diversification, like gold and other commodities, were now moving in lockstep from a vol and otherwise perspective with the underlying, so diversification was becoming more difficult. We've seen that kind of come off a little bit since then, where the cross-asset correlation and the volatility wasn't really as high. Are you starting to see that creep in a little bit again? What's your take here when you're analyzing all these products and comparing them on a volatility perspective? Are we starting to see the cross-asset correlation increase again?
I think that when it comes to things like my view about things like fixed income is that I think that the change from a forward guidance to actually thinking about moving Fed funds rate is something that it's obviously never been done before. Where exiting QE is a new thing, and I'm pretty happy to be agnostic about what to expect. It's not fixed income isn't my specialty. It's more important than ever, I think, at the same time. So I'm trying to educate myself a lot more too. So I mean, for any trader who knows as much or less than I do about fixed income, my advice is to stay as agnostic as you can and not always take trades that, even if they look obvious. And if you are going to trade fixed income, to trade in the shorter term products rather than in the 10-year or the long bond even. With regard to gold and metals and things like that, look, I think a lot of traders were looking for unintended effects of QE and sort of apocalyptic economic scenarios, I guess, and I think that's been pretty soundly disproven by the price action, if nothing else. And so that might be some of the reason why the bid in gold is going away. You also have central banks not buying quite as much gold as they had been, and even on the level of shorter term correlations, I think that the gradual improving growth prospects for the U.S. Makes it, God forbid we use that cliche that it's a stock picker's market. But in this case, we've been so used to thinking about macroeconomic risks and big picture scenarios for the last 5 years and more that with growth in the U.S. really starting to pick up and some prospects improving, I think that you really are starting to see traders look more at the level of equity sectors and even at the level of individual companies in ways that we wouldn't have thought to do as much 2 or 3 years ago.
Well, Jared, like I said, there's a lot we can keep going on with, but we have to roll on with the rest of the show. Luckily, you're going to join us for our other 2 segments, so it's time to keep on rolling right on into our volatility review segment.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
My team is plaguing me with the music in the drops there, putting all sorts of songs to hum along to in my head while the show's going on. Well, of course, welcome to the Volatility Review. This is, of course, a portion of the show where we break down the week's worth of action, the week that was, if you will, from a volatility perspective. And it was yet another interesting week. We saw volatility, S&P volatility in particular, aka VIX, really catching a little bit of a tailwind earlier in the week, holding some key levels. We're recording this, listeners, today on Friday, February 28th, day when we're seeing a little bit of the vol coming off. Not surprisingly, markets overall are rallying a little bit. We're going into a weekend, so some of the vol coming off ahead of that, perhaps not as much as you might think. But before we even get into that, both of you guys, Mark and Jared, I want to put something towards you because I saw a lot of people talking about something this week that really bothered me. A lot of people, whether it was, I don't care what your outlet of choice, CNBC or writing on a lot of other publications, Bloomberg and others, referring to this quote-unquote long-term average of VIX being 20, and that the fact that we're at 14 now on the VIX cash or whatever, or 1376 as we're recording this, is somehow historically well below that long-term average. And I'm a former SPX guy. I, of course, remember when VIX of 15 was crazy. That was crazy town. So the notion to me of a long-term average of VIX in anywhere in the 20 range just seems crazy, and B, seems to be horribly skewed by a few data points from 08, 09 in that range. And if you take those out, I would have to wager that the long-term average is actually somewhat lower. Maybe, Mark, we'll start with you. What's your take on people banding about this, long-term average of VIX in the 20 range?
Well, there's actually a blogger out there. It's of the Jared ilk that spent a lot of time looking at this, and he did a blog, and basically he ran I think there's where people get confused is they think mean is normal, and it's not necessarily normal. The guy did a long-term kind of histogram of where occurrences are most likely to occur, and basically concluded that like the center price for the VIX over the last, 15, 20 years was like 17.8, which intuitively to me makes a lot more sense. And additionally, the way you got to think about vol is not that, it hovers around 20. It's that it actually goes through channels. There's periods of time where the mean over a 3 or 4 year period will be 12, 13, 14. Then there's periods of time where the mean over a 2 or 3 year period will be 22, 23, 24. And part of the reason that mean is 24, 25 or whatever is because there are a couple of big bad occurrences there. And, I think that's more where expectations should lie with the VIX, that, if you study vol trading, when the VIX is low, all you ever want to do is sell it until it starts to break out. Then all you'd want to do is own it. And when it comes to kind of trading the VIX futures and owning them. And so it's not, when the VIX is trading 14, it is easier to make money being short vol than long. It's plain and simple.
I figure I want to know what the underlying equity is doing. If the equity index that those options are linked to is moving at a rate of 20% annualized vol, then maybe that's really low. Right now, you have S&P 1 month vol is what, in the low teens. I think the 10-day is down near like 6 or 7% annualized. So in that context, a VIX at 13 is kind of really high, and my point being that I'm only ever interested in implied vol in relationship to what those underlying assets are doing. Otherwise, it's just a number.
Let's talk about that then for a second, because we saw some interesting developments in that, aka the risk premium over the past few weeks. Historically, of course, implied always got a tailwind versus realized. We saw that script kind of flipped back when we were moving 1% or more a day in the S&P for a while there. Realized was kind of blowing the doors off of implied, and now we're starting to see that flip go back to a little bit more normal again. So first off, Jared, let's start there. What's your take on this week that we saw here from a vol perspective? What in particular caught your eye? And then B, do you think maybe we're looking at a prolonged period of back in the old normal risk premium paradigm, or you think Realize is going to catch another tailwind again sometime in the near future?
I would, for this year, I wouldn't be surprised if you had, if we had lots of like little pockets where vol stayed bid surprisingly often. We talked about 2 occurrences so far this year, like the most recent week just now and then earlier in February. And I wouldn't be surprised to see this again with the net result. Like if it's the end of 2014 and we look back this year, I wouldn't really be surprised if traders who were short the first and second month VIX futures actually had a pretty bad to mediocre year, while people trading a little bit further out on the curve might do okay. And what would drive that would, like we just said, be short-term vol staying bid a little bit more than we'd expect, even while equities in terms of realized vol could remain low. And I wouldn't be surprised to see that happening.
And Mark, what in particular over the past week's worth of volatility and VIX action really caught your eye?
Like I said, just the stiffness of volatility and how firm it's been all week and really all month. The VIX, 14 seems to be a line in the sand. The market is not willing to sell below for very long. Here we are. We're going into a long weekend, and the market's basically marginally up, and VIX is barely in. They haven't been giving you the weekend even. It's been a much more, Monday's seen bigger vol crushes than Fridays, which has been really surprising.
Yeah, that's not exactly the narrative we expect to see play out at all out here. So interesting waters. Listeners may remember we had a great listener question last week about the India VIX and how we thought that performed versus things like traditional VIX, because it doesn't have all of the ETP baggage going on about that. Well, we saw actually about 2 days ago now, there has been some developments on that front. In particular, the options have been trading out there for a while. We now finally have some VIX futures out there. They were launched on February 26th over there on the National Stock Exchange of India. And it's nice because it finally gives an actual underlying to all the stuff that they've been slinging on or out there for some time. Of course, we've seen the India VIX kind of trailing what we're seeing over here domestically as well. It was hovering around about a 19 level in the Indian VIX cash, and then dropped down to about where we are here, about sub 15 levels in more recent times. What I thought was really interesting as well too is that I was looking at this written up in a couple of different domestic publications over there, including the Economic Times of India, and all of them had essentially big red warning signs in the articles. I said they wrote here, a word of caution here: retail investors should avoid this product as the rate and magnitude of the change in prices could be extremely high on particular days. A bigger lot size effectively means the gains and losses would increase even more, making it a high-risk product for retail investors. So there you go. Most of the major publications over there in India warning the retail away from Indian VIX futures. Not exactly surprising. The VIX futures over here even haven't exactly been, let's say, a banner product for retail. Most of the retail is still aggregated over there in the options volume. But it is kind of interesting. It gets to what we were talking about earlier, Jared, as well, about some of these emerging markets and the volatility. I would think, from your perspective, the addition of an actual underlying, a VIX future now, would make the Indian VIX a little bit more relevant, a little bit more reliable, and perhaps a more meaningful indicator for you when you're looking at emerging market type volatility and indeed cross-asset volatility. So does this development excite you at all?
Absolutely. Yeah, I think it's fantastic. I read that I think there was an article in Risk Magazine mentioned recently that there was a lot of institutional demand driving these products rather than just somebody at an exchange having a good idea or something like that. And so I really hope it takes off. I think it's a fantastic thing that they've launched, and I hope it attracts a big audience. It definitely gives you a little bit more information about what's happening in that market than you could get just from say, options on the equity index alone.
Jared, what are your thoughts on? I know this is kind of off subject, but what are your thoughts on the VXST and the concept of that future?
Well, like, I don't know if you remember when they launched options on VXX way back. I was really skeptical. I don't know if I wrote anything about it or not, but I remember talking to you and Bill, and I just thought, oh, this is probably like not something I care about or I'm interested in at all. And man, was I wrong? Like, and it's funny because now these things have become so successful. And I think VXXST is going to be another case where it's had a little bit of a slow start, but I think it's a really interesting product, and it's something that I could see finding a big audience. I think even if you don't want to jump in and trade it right away, I think that watching how it moves is really interesting, is valuable. And I think that there's some definite use cases if you're going to trade short-term events where the product would be expected to move a lot more. So I hope it does really well.
But yeah, Jared, Mark and I were talking about this on last week's episode about VXST and how, for all the noise about it, it is somewhat a hard product to get a handle on. There's not much being really disseminated about it. It's kind of hard to find the actual volume numbers that are going up in it. So it's interesting. Certainly, you're right, because it just plays in that very, very near term of the curve. I'm just hoping that we do see, you're right, a little bit of pickup in action. In terms of volume, is it still a little lighter than you expected, given all the buildup that we saw to this product?
I think I saw a day or two this week where there was 50 or 60 contracts traded, something like that. And honestly, I thought it'd do a little bit more. There's that theory that gets bandied around that you guys probably mentioned here too, I think, where the story goes that it was really the financial crisis and the popularity of the exchange traded products that really drove volume towards the VIX futures. And if that story is true, then it would explain a lot, and it would explain why some of these other indexes that have been launched and volatility futures that have been launched in the years since haven't found as big of an audience. It kind of makes you wonder whether the exchange traded fund side of things is, if that's the big driver, maybe we should be looking for more kind of contemporaneous products launched there to sort of attract some interest and attract some retail order flow. Although I don't know, given that, if you think about the long history of understanding and misunderstanding around VXX, I don't know that a VXXT exchange traded product would be taken up with the same, I don't know if it'd be taken up with the same level of clarity or not. So that's kind of maybe a fraught thing to hope for.
Well, and I think, Jared, the other piece is the VIX is based on the VIX is really derived from a contract that was already trading upstairs in a lot of ways, or was used to deal with risk related to upstairs people. And really, none of the other products really do that. And I think that actually has a lot to do with it as well.
That's a good point. Yeah.
Jared, I'm glad you mentioned the kind of universe of ETPs. That, of course, a very hot, somewhat contentious topic whenever you discuss things like VIX, because you're right, this entire spectrum of products has arisen around the VIX product, all of these ETFs and ETPs, 2X inverse. I don't care what your flavor is, you can probably find it in a VIX ETP somewhere. And so a lot of people have started to question the validity of VIX as a result, because you have all these different products pulling in all different directions. And there seems to be kind of a bit of a schism in the volatility camp, where there's one half who kind of says, yeah, VIX, I don't really watch it as much anymore because it has all these other masters and the tail is really wagging the dog. Look at beginning of the day, look at end of day and how much it moves compared to what's going on in the S&P. It isn't really much of a pure gauge of S&P volatility anymore. It's kind of polluted, I think, for lack of a better word. And there are others out there who say, no, that's still not really the case. And you can still look at it as a pretty decent measure of the implied levels and what's really going on out there in the S&P land. So which side of that heated and contentious debate do you fall on, Jared?
So I wrote this article called it's about how VXX and these other ETPs do exactly what they do what they say on the tin. They do what they promise to do in their prospectus. And I think that a lot of the criticisms are based sometimes around things that we wish were the case rather than what's actually promised. There's no real inherent relationship between volatility futures ETP and the spot VIX index, other than that sort of gradual convergence. But they certainly don't need to track one another in any precise way. And more importantly, I never really have seen any evidence that was convincing to me that order flow in the exchange traded products was having any adverse or sort of skewing effect on the pricing in the futures markets. It would be weird if that were true. If anything, it's just kind of order flow and volume through another channel. If you imagine that all the exchange traded products disappeared overnight, then presumably some of that same capital would go into the volatility futures themselves, and even with the way things are, when an investor buys an exchange traded product, the issuer of that note has to turn around and hedge it somehow, usually through the vol futures markets, or maybe OTC. But in any case, that represents real capital that's wants to buy or sell in that space. And so I take it as valid and totally meaningful order flow that I can't see any reason why it would have any sort of distorting effect.
There we go. A vote for calm and reason in the great volatility debate. I would expect nothing less from you, Jared. You're a very calm and reasonable guy. Hard to get you excited here on the old show. But it's time to close out the volatility review and move on into our final segment, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, welcome to the crystal ball. As the man said, this is the portion of the show where we peer into the future a little bit and tell you what we're looking at, what we're expecting perhaps from the world of volatility and volatility trading. Jared, since you're our guest, we'll give you pride of place here. You get to go first. You touched on it a little bit in the earlier segment, how you thought the realized might actually be able to catch a little bit of a bid here or there and remain somewhat resilient. What else are you looking at? What else are you expecting over the coming week, or probably a little bit longer for you because you won't be back for a while? So a little bit longer perspective for you in terms of implied and realized vol and whatever else you're kind of watching for the next few sessions.
Yeah, like I said, I think that one thing that I'm keyed into is where the richest premium is in the curve. I think that so many people have been trading in the short term part of the VIX curve. I think you had Chris Cole on recently, who probably said something along these lines. I mean, this is a point that he's made to me a few times, and I think it's a great point that when you have too many people at the short part of the curve, it's not a huge deal, but it means that there's a little bit less premium there than would be otherwise, and that means there's probably less value, less return for unit of risk. So I've been trading for a while in the middle and longer parts of the curve, and trading around a little more actively in there. And I think that that's something that that people are probably going to be get better returns for on a risk adjusted basis over the next few weeks and months. With that said, you had a big bid in like the April VIX contract this week, and actually was enough that had me rolling from April to VIX. I had some small stuff on in April, and had me rolling from April to May. Just some small stuff I had on there because it may just be whether it's people who are buying that contract to hedge earnings or whatever it is. You've definitely seen the bid in vol, and I would expect that to come out. But in case it doesn't, in case we get some of a downside move, I think that from a volatility selling point of view anyway, my view that there's better value right now in the medium term.
And Senior Sebastian, what are you watching? What are you keeping an eye out for until the next time you and I sit down here on the program?
I here we are again in the last couple of minutes. I think the S&Ps are going to go red today. The futures just did go red, and the VIX dipped below 14 only to bounce off of it. So the market is basically saying that we're not going to let the cost of insurance get too cheap. If you want to put on a collar, you're going to pay for it. If you want to put on a risk reversal, you're going to pay for it. And I'll be interested to see how long that holds. Does it hold all the way through non-farms, or is this some sort of hint that non-farms is going to be market moving one way or the other?
All right, and that's going to bring this episode of Volatility Views to a close. But before we go, as always, I want to check in with each of my cohorts here, particularly our guest, and see what they have cooking that may interest you. So, Jared, we hit on a wide variety of subjects on today's show. If listeners want to find out more about what you're doing, get access to your research or some of the funds that you're managing, where should they go?
Go to condoroptions.com. There's a contact form there that you can reach me. Or just Jared at condoroptions.com. If for managed accounts, the website is clinamengroup.com, and that's kind of to spell. So just go to Condor Options, and I'll send you there. And people are interested in the research, want a different take on on looking at the markets. I don't really do any technical analysis. Don't really look at fundamentals as much, just a little bit. But lots and lots of volatility, and that's all backed by data. So I think that there's something there that people probably haven't seen everywhere else.
And Mark, what's cooking in the land of the pit in addition to the big developments over there with Swan Re?
Oh, we're overhauling some of our content. Should be out this week with some big announcements. But yeah, market's now down in the day. Unbelievable. You have no idea. I had to take off 2 bad losers because of this rally, and I knew this was going to happen. Makes me so. I should probably.
Isn't that always the case?
Explaining.
That's the best indicator something's going to reverse is when you take off.
Although what's interesting, I had a big position that I really like, and we're about two points away from me having to take that thing off just for risk management purposes, and we bounced off. So, at least that's safe.
There you go. See, coming on Volatility Views allowed you to distract, not touch it, and it worked out.
There you go.
It's all about the vol views in the end. All right. And on behalf of Mark and Jared, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. Keep them coming. We didn't get a chance to get to them this episode, but we'll get to them next week. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. Or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.